Good afternoon and welcome to the second session of our 4-money lecture series by the Institute of International Monetary Research in collaboration with the Vinson Centre at the University of Buckingham. This is a series on the evolution of central banks and their roles in financial crisis by two very well-known experts in the field, Professors Charles Goodhart and Professor Capie, both members of the IIMR Academic Advisory Council. I'm Dr. Juan Castañeda, Director of the IIMR, and today we'll be hosting Professor Charles Goodhart. Charles Goodhart needs no introduction. He was trained as an economist at Cambridge and Harvard. He then entered into a career that alternated between academia at Cambridge and LSE and work in the official sector, mostly in the Bank of England, in different departments, the Department of Economic Affairs of the Bank of England, and then as a member of the newly established Monetary Policy Committee from 1997 to 2000. He has worked throughout as a specialist monetary economist, focusing on policy issues and on financial regulation, both as an academic and in the Bank of England. He devised the so-called the Corset in 1974, advised Hong Kong authorities on the link in 1983, and the Reserve Bank of New Zealand on inflation targeting in 1988. As he puts it, he has written more books and articles on these subjects throughout the last 50 or 60 years than any sane person would want to read. Professor Charles Goodhart will discuss today the second part of his lecture on central banking, past, present and future, after which we will allow time for Q&A with viewers at home. Today's presentation will be recorded and made available on our YouTube channel. Questions must be submitted via the chat option, and I will moderate them and address the speaker. Charles, we are again very grateful for your collaboration. This is your second lecture in this series, and we are honored to host your seminar. So please, the floor is entirely yours. We will just have some time at the end of your presentation for Q&A. But again, take your time to make the second part of the presentation, please. Thank you.
Thank you very much, Tom. Welcome back. I'm very glad to be able to carry on. Where I left you last time was with central banks struggling to deal with the current COVID crisis. Where I'm going to start this afternoon is with some future developments, some future trends, which will affect how the context in which a central bank could work. Some future trends. One of the major developments over the course of the last 30 years has been that the labour supply available to employers, particularly those who can place their factories anywhere in the world, the available labour supply has increased really very, very sharply indeed, with the result that the employers have shifted their factories when they could from the high wage countries in the West, in Europe and in North America, to the lower wage countries, particularly in Asia and notably in China. Now, all that is going to stop and indeed reverse. Demography is going to worsen very sharply. What has been happening has been that after the World War II, there was a very massive increase in birth rates, what was known as the baby boom. And the baby boomers have been working their way through the working population. For the last or so 30 years, women have been having fewer babies than consistent with a stable population. And the number of young who need to be looked after, who are below working age, have been declining very sharply. And that decline has been far greater than the rise in the old and the retired. Although the expectation of life has risen quite sharply, the number of old has been rising more slowly until now than the decline in the young, with the result that the proportion of workers in the population have been growing very sharply. And not only that, in China, for example, there was a huge shift of workers who were really just subsistence farmers from the west, the internal China, to the coastal areas in the east, where they became much more productive in factories and so on. So that what we're now going to have is a very sharp worsening in the availability of labor, with the exception of parts of India and the whole of Africa. The dependency ratio, that's a ratio of those who needed to be looked after in the sense that they weren't working and weren't producing income, but nevertheless had to be helped with consumption. The dependency ratio of dependence to workers is going to rise very sharply. And that in itself will be inflationary, because workers by definition are deflationary, because you wouldn't hire a worker unless the value of what they're producing is greater than the wage you have to pay them. On the other hand, dependents consume but don't produce, and therefore they raise demand but not supply, and therefore a worsening dependency ratio is going to make everything more inflationary with demand greater than supply. One of the implications of that is that the rate of taxation on workers of all kinds, highly paid skilled workers as well as lower paid, less skilled workers, will all have to go up in order to pay for the health expenses, the care and the pensions of the old. And all of that will generate inflationary pressures, which we're slowly beginning to show against the momentum of the disinflationary pressures of the last 30 years. When that inflationary pressure was going to break through, nobody quite knew, but the COVID crisis is likely to accelerate the change in trends, partly because of the monetary and fiscal measures that have been taken to deal with the crisis, which have all been extremely expansionary and will in turn lead to inflationary pressures once, but only once, the COVID crisis has been fully and properly overcome, though nobody knows exactly when that will have to be. So in order to keep the inflation targetry and price stability in place, interest rates would have to rise back up, subject of course to technological changes such as robotics and artificial intelligence, which may raise productivity per head in coming decades, and we will badly need all such technological wizardry, because we will have fewer workers, and many of those fewer workers will be caught up in helping to care for the aged. But the central banks will find it very difficult to raise interest rates for a number of reasons. First, they now have really quite extraordinarily expanded balance sheets. The ratio of the liabilities of central banks to GDP are now higher than they ever have been since central banks began, in particular higher than they ever have been in the UK, when the Bank of England was once a really commercial bank, as only a small nascent central bank, and the Bank of England at that time was the biggest and most important bank in the whole of the country. The Bank of England's balance sheet is now even higher than it was back in the 17th century and early 18th century at that time. Now, what has also happened is that for a variety of reasons that I won't go into, we have shifted our monetary operations from what is known as a corridor system, where the deposit rate that banks can obtain from putting deposits reserves with the Bank of England bore a zero interest rate, to one what is known as a floor rate of interest, where the commercial banks receive the current going short-term interest rate on their deposits held with the Bank of England. The balance sheet of the Bank of England is now so large that if interest rates on their liabilities start to rise, the Bank of England would find that their profitability also frequently known as seigniorage, would disappear, and that would have political problems for them because they'd have to go to the Treasury to get bailed out, and would leave them open to attacks from populist politicians. One of the results of that is that central banks generally, and the Bank of England, the present Governor Andrew Bailey in particular, have already said that in the process of normalization, they will try to run down their bloated balance sheets before they start raising interest rates. One of the effects of that will be to make the slope of the yield curve, that's the difference between short rates and long rates, which at the moment are flatter, with long rates very low relative to short rates, much back to normal or even greater, with a higher yielding long rate and an upward sloping yield curve. Again, debt ratios, as I shall show later in this presentation, have increased so much under the influence of very low interest rates, which has encouraged people to accumulate debt, even more so with the amount of massive debt increases that have occurred during the COVID crisis, that any sharp or sudden increase in interest rates would bankrupt huge proportions of the non-financial corporations and push us back into recession, which would do nobody any good at all. Furthermore, there will be political pressures for growth. You can already see that in the sort of things that Trump is saying now. And growth will, as a generality, be lower, because growth is a combination of the increase in the working population and the productivity of that working population. And if the working population is in fact declining, as it will be in many countries, there would have to be a miracle increase in productivity in order for growth to be as high as it is now. And then finally, we've got the effects of the present crisis. So it's going to be much, much more difficult for central banks once COVID has been beaten and we are back to something closer to normality to maintain their inflation target at present levels, with the result that there'll probably be more inflationary pressures and somewhat less independence than they have enjoyed in previous years. Can we move on to the next slide, please? And this is going to be a major change from the trends that have been operating over the last 30 or 40 years. These trends have been remarkably favorable for central banks and for their operational independence. Because of the disinflationary pressures coming from demography and globalization, the interest rates, both nominal and real, have trended down over the last 30 years, although, as I said in the first presentation, central banks didn't actually have to do too much to bring that about. And indeed, they've been struggling to bring inflation back to normal, back to their target level since about 2008. So it's clearly, over the last 12 years or so, not been monetary policies that have driven inflation down. It's been something else, which the globalization and demography, against which the central banks have been trying to fight. A result of all this has been that although debt ratios have been rising really very sharply, with a few exceptions, banks have been forced to have a much higher equity ratio after the great financial crisis, and in Germany, debt ratios, particularly public sector debt ratios, have been held down and have actually been falling. The debt service ratios have remained low and steady. That is, the amount of interest as a percentage of GDP that either corporations or the government have had to pay out have held constant or even been falling very slightly, despite governments, corporations, and in many cases, persons with mortgages on their houses, their debt service ratios have remained very low and steady. The result of all this has been that borrowers, especially the public sector and corporates, and those who have been fortunate enough to have got on the housing ladder, to have been able to pay the down payment necessary to obtain a mortgage, have gained. So those already holding assets, the old and the rich, and debtors have gained dramatically. The losers from all this have been savers without assets, the young and the poor. But these have actually tended to blame governments, not so much central bank policies, for their problems. And what has happened is that in some aspects of wealth inequality have got a lot worse because those right at the bottom of the pile, whose parents don't own their own homes, whose parents and they themselves don't have much in the way of financial assets, find it very much more difficult to put together the money necessary to get onto the housing ladder. Okay, on to the next slide, please. Now, the next couple of slides, this one and the next few, are simply to show in diagrammatic form the dramatic run-up in nominal interest rates that has occurred, and then in nominal interest rates, and the steady decline in real interest rates since the 1980s. This is a picture of the US. You can see the nominal interest rates on the left, short-term and long-term, and the real interest rates after adjusting for inflation, which were very low in the 1970s because inflation was so high that even despite the rise in nominal interest rates, real interest rates after inflation adjustment actually fell. But when we managed to conquer inflation in the early 1980s, real interest rates actually rose very, very sharply and have been declining considerably, a trend decline ever since. Can we go on to the next slide, please? And the same has been happening in the UK. The diagrams on the left give a longer time horizon than on the right. You can see again the massive upsurge in nominal interest rates, short and long, that occurred from about 1950 onwards, and their equivalent precipitous decline afterwards. And over the shorter time horizon on the right-hand side. And again, the real rates, the UK real rates, note a point that many people have made, that real rates, although they've been declining, are not necessarily that low in comparison with some that have occurred historically. In particular, at times when inflation has been much higher than interest rates, notably in wartime, you can see the two collapses in real interest rates in 1914 to 1918, and again in 1939 to 1945, and again during the 1970s when inflation was allowed to get out of hand. So real rates, although declining, are not that dramatically lower than on average. Okay, on we go. Next slide, please. Again, I've gone through that. The point of having that slide up again is just to say that I'm now going to show you some diagrams on debt ratios, which is the next slide, please. Now, this really is, in my view, really quite a dramatic couple of slides. The blue line shows the increase in the government debt as a percentage of GDP, and you need to look at the right-hand axis to see the particular levels. Note that this ends in 2018 because we haven't got the figures for 2020. When the figures for 2020 come out, say the end of December 2020, the UK figure will be over 100, probably about 105%, almost 20% above 2018. And again, the US figures will have jumped by some 20%. And what you can see is the yellow line is the interest rates. And so the debt service ratio, and both the interest rates and the debt service ratio, you need to look at the left-hand side axis to see the numbers. The debt service ratio in the US, having gone up in the 1980s, then actually remained absolutely steady or slightly declined. And virtually the same is true in the UK. In the 1980s, in order to conquer inflation, we raised interest rates a lot. And that was before there was this major increase in public sector debt. So for a time in the 1980s, the debt service ratio increased quite a lot, after which it has stabilized and, if anything, gone down. So in terms, if you like, of the burden of paying interest, there really hasn't been any worsening of that yet for either the public sector or for corporates. Can we go on to the next slide yet, please? Now, all this is going to change because interest rates cannot go down, nominal interest rates cannot go down any hardly at all further because of the effective lower bound or the zero lower bound. And if I am correct that inflation will over the next 10, 20, 30 years be rising, interest rates will have, nominal interest rates will have to rise in order to maintain price stability and inflation targetry. And that means that the increase in debt, which is now getting even worse, is going suddenly to snap back in bringing about a huge increase in debt service ratios, which will be absolutely total change to what has occurred in the last 30 years, where although the debt ratios have been increasing dramatically, the burden of that on the debtors, the public sector, and the non-financial corporates really hasn't got any worse at all. What has happened has been that the relatively expansionary monetary policies and bringing about or encouraging a massive increase in debt have raised debt levels in all our economies to a point at which we are going to find it much, much more difficult to deal with that by the standard policies of raising interest rates, because the burdens will be so very much greater. And so one of the questions, in a sense, looking backwards is, could it have been different? Could we have done something to maintain our stability and our growth without lowering interest rates to a point that encouraged debt expansion to such a great extent? Now, probably the only or best known institution which has been continuously worried and worrying about this massive increase in debt has been the BIS, the Bank for International Settlements. The problem is that all the BIS offers as a suggestion about what could have been done or should have been done is supply side reforms. Now, we all like supply side reforms, but if they had been easy and possible and political acceptable, they would already have been introduced. And generally, the BIS has been just crying for some unstated supply side reforms to get us out of this trouble without specifying what they were and how they would work and how they could be introduced. And remember that many of the supply side reforms actually start by worsening the quasi-monopoly position, for example, of taxi drivers with the introduction of Uber, which in its first stages worsens the position of that part of the population which no longer has the cartelized monopoly benefits, before it has a generalized beneficial effect by making the cost of our commodities and services cheaper. So I think the idea that a sort of Cinderella in the shape of supply side reforms is going to miraculously emerge to get us out of this difficulty is extremely unlikely. One of the problems that we have all faced during recent years has been that although equity prices have been sky high, debt costs have been extremely low, interest rates have been extremely low, corporates actually haven't undertaken very much in the way of investment. And there are reasons for that, in that corporate managers have found it much easier to improve the relative position of shareholders by undertaking a buyback approach whereby they actually raise debt to buy back equity. There's a whole series of books by my friend Andrew Smithers on how the bonus culture and the short-termism of management that engenders has led to a reduction in corporate investment, and how that has been a major problem in the operation of our capitalist societies, and how and why we need to try and change that. Again, one of the reasons why there have been such difficulties in trying to bring back inflation to normal target levels has been that quite a number of the creditor countries, the international creditor countries, notably Germany and China, have taken very considerable steps to try and protect their competitive position from being eroded by the increase in monetary growth that would have occurred had they allowed their current account surpluses to be reflected in greater domestic monetary expansion. As a result, through a variety of mechanisms, capital controls and outward capital flows, putting a great deal of the monies generated by their current account surpluses into holding of US treasuries, they have managed to maintain their low-cost competitive position, which in turn puts more pressure on the deficit countries to expand in order to maintain equilibrium and employment in those countries. In this respect, President Trump I have a certain sympathy for him in his attempt to put pressure on those countries, and indeed the oil-producing states in the Middle East, in order to be much more expansionary than in the past. But it's very difficult to get a country that wants to maintain its competitive position to expand more than it wants. It doesn't need to, and in general they haven't, so on. Another possibility is to remove the tax advantages on debt. And it actually beggars belief that we give tax advantages to a form of providing funds to borrowers, which make us all more fragile, as compared with equity financing, which actually makes us stronger. So the tax position on the relative position of debt and equity really does need to be rebalanced, and there's been very little that's been done on that front. There's been a suggestion that moves somewhat along those lines to introduce what is known as border adjustment taxation, which would allow for much higher taxation, particularly on footloose companies where they can sell their technical wizardry into any country that they want, while being headquartered and facing costs anywhere that they want. But this has been fought off by the Americans because most of the technical companies, Apple and Microsoft and the rest, are headquartered in the US. Whether a President Biden would be any more willing to allow border adjustment taxes than President Trump remains to be seen. Still, we can try and do certain things, but it's going to be difficult. Although the central banks were expected to oversee financial stability, there was really only limited criticism for their failure to foresee and prevent a financial crisis. The main criticism fell on commercial banks for being prepared to reduce their equity and indeed their liquidity to a point that put them at severe risk. And indeed, there's been a great deal of praise for central banks for their robust and innovative response to the crisis, with many more powers on macroprudential and indeed microprudential measures than they had before. Nevertheless, there have been growing criticisms. One of those was raised in a question at the first session was, does it not extend the mandate of central banks too far? Are they not now entering the political arena when they're telling banks much more what to do and how to do it? Again, as I said earlier, wealth inequality has been increasing. The debt trap is becoming worse and worse. And there's been, ever since the great financial crisis, a very weak recovery, in part and particularly in Europe, because the move towards negative interest rates has put bank profitability, the spread between the rate that bank can charge on their loans and the rate that they receive on that they have to pay on their deposits, the spread between the deposit rates payable and rates chargeable on loans, that has been compressed to a point that has reduced the ability of the banks to support the recovery in Europe. But there's been really no serious attack on central bank independence yet. Okay, on to the next slide, please. Now, this is really just to illustrate some of the debt ratios. And note again that the debt ratio, the right-hand side table, only goes up to the end of 2018. And the figures for the end of 2020 for most governments will be at least 20% worse. And for most non-financial corporations, NFC stands for non-financial corporations, and HH stands for households. The redder the marking on the table, the more severe is the debt position. And you can see how the debt ratios of governments, particularly Japan, 240% of GDP at the end of 2018, which will be, most of these countries, with the exception of Australia and Germany, will now be over, and Sweden, will now be over 100%. And look at the bottom table, the change since December 2007. You can see that Germany is the only one with minus, where the debt ratios have been declining. For almost all the other countries, the debt ratios of the households, non-financial corporations and governments have been increasing. And that increase is now probably about, in many cases, twice what is shown on that table. And it's not only the advanced economies where the debt ratios have been increasing very, very much and are now historically quite high, higher than ever before in peacetime, though not as high as they reached during the wartime peaks. But the same is true in the developing economies as well. Can we go on to the next table, please? Next slide, please. And here you've got the same figures for China, Korea, India, Indonesia, Malaysia, Thailand, Hong Kong, and so on. And again, the figures will be considerably worse at the end of 2020 than they were in December 18. And some of these figures, particularly, for example, China, but also some of the other countries, such as Chile, Argentina, some of the South American countries, are really quite staggering. They'll be very careful in China because a lot of the private sector is actually under government control, and the government has got, compared to most other countries, the government in China has got a lot of fiscal leeway, which it could use to bail out the state-owned enterprises or SOEs. Okay, on to the next slide, please. Now, assuming that we get through this COVID in the next year or two, we get some vaccines or herd immunity, and nobody quite knows how long that will take. But once we have normalized monetary policy, the central banks will no longer be the best friends of borrowers. As I showed earlier, debt ratios haven't risen at all, although debt has risen remarkably. And debt is going on to rise remarkably. And now, rather than a continuing trend decline in interest rates, they'll probably have to go up. That means that the debt service ratios, which are the burden on the debtors, will get worse and worse and worse. And among the worst debtors, the government. And how will the politicians react when, instead of central banks bailing them out by lowering interest rates, central banks want to raise interest rates in order to stabilize inflation? Will the politicians override the central bankers and say, stuff you, I'm not going to allow you to raise interest rates because I want growth to continue and I'm frightened about recession? And if with the increase in non-financial corporate debt, a hell of a lot of corporates are going to be bankrupted simply as a result of COVID. And that's going to get worse should interest rates start going up again. How will we actually handle vast quantities of corporate insolvencies and the effect of that on our banking system? Effectively, we're in a debt trap. The debt trap is very simple. We got a huge amount of debt. So we got so much debt that if we try and raise interest rates, we may run into a recession. So we can't raise interest rates. But if we can't raise interest rates, the incentive to increase debt yet further continues. So how do we get out of this? Well, the first and most desirable way is growth. You know, if we have more growth, then the ratio of an existing debt to GDP goes down as GDP goes up. But the problem is the same demographic problems are going to mean that the decline in the working age population in many countries, or its stagnation, are going to mean that we're not going to grow. Can we just cancel debt? Sort of a jubilee. I mean, they used to back in the sort of in Babylonian times in Assyria and the early days of Israel and so on. It used to be done on a regular basis. But now most debt is done through the intermediation of financial intermediaries, including banks, pension funds, insurance companies. And if you cancel debt, they'd all be gone. They'd be dead. And that would mean that those who have their money in pension funds and insurance companies, let alone bank depositors, would be dead as well. So that's hardly possible. Can we just default? Well, not really, because you can't borrow again if you've been defaulted. Effectively, one of the things we could do, but we are not yet doing, is encourage a massive great switch from debt finance to equity finance. But beyond that, I fear that the future 30 years will at some stage, not until after the COVID problem has actually been settled, there will be much more inflation. And we will have to encourage a massive change in the way that corporations and possibly even governments are actually financed. A switch to equity type finance rather than debt finance. Okay, on to the next slide. Is there another slide? I can't remember.
This is the last, Charles, of your presentation.
Oh, very good. Well, that's a good place to stop. I think that I would like to end by saying that life has actually been very good for central bankers over the last 30 years. They've become public figures, almost rock stars. And everybody knows the name of the heads of our central bank. And they appear in the press sort of virtually every day. Now, in the 60s and before, that wasn't the case. I don't think it's going to be the case for that much longer. The great glory days of central banking may well be over. And life is going to be very much more difficult for them, and it's going to be difficult for us. Living in a world of slower population growth, and of that population growth, a massive proportion increasingly being the very old, who need to be cared and looked after. So growth inevitably is going to be slower. It's going to be hard. To those of you listening who are, as many of you are, young, between say 19 and 23, I don't have a great deal of cheer. You're going to have much higher tax rates, and you're going to have to work much longer in your lifetimes. The idea that you're going to be able to retire at 65, you won't. You'll be lucky if you can retire when you're 70, and beyond that, the pensions that you'll be able to accumulate between now and then will be much more niggardly. The public sector pensions, government pensions, that will be, so you'll have to provide much more for your old age. And a lot of things will be better, but there'll be for the old like me, and for the relatively rich and relatively skilled, again like me, and the last 30 years have actually been wonderful and just marvelous. If you were low skilled in the developed countries, the last 30 years have been pretty damn difficult because you were effectively outcompeted by the Chinese. But it's not going to get that much better. It will get a bit better for the low skilled, in particularly the massive within country inequality will, I think, decline. But it's going to be it's going to continue to be a fairly tough life for all of us. And in particular, for those with capital and high skills, like many of you, is not going to be such a rosy spectacle as it has been over the last 30 years. I'm sorry to be maybe a bringer of bad news, but beware, the future isn't going to be much fun in many respects. The answer to the first is that central banks are very sensitive about being accused of worsening inequality. And their answer has been that income inequality has probably been reduced by their policies. The reason that they say so is that without the expansion of monetary policy, our economies over the last 20 years would have had much less in the way of employment, and the unemployed are generally the poorest and the least able to fend for themselves. So that if you talk in terms of income inequality, monetary policy has almost certainly been beneficial. If you talk about wealth inequality, it's a much more nuanced and difficult issue. And the reason why that is that in countries such as the UK and the United States, something between about 50 and 2/3 of the population own houses. The effect of the reduction in interest rates has been to generate a massive increase in housing prices. And if you own a house, you are party to that. And the effect of the increase in housing prices, which has benefited up to 2/3 of the population, has outweighed the impact on equity prices, which are primarily held by the top 1 or 2% of the population. So on some measures of inequality, even wealth inequality has not risen. But, and there is a huge but, that proportion of the population which does not own a house, rents in particular, and is not in a position to enter the housing ladder, has worsened. Its relative wealth inequality has worsened dramatically. So the bottom quarter or third of the population, wealth inequality has worsened really very, very sharply. If you talk about the sort of top 2/3, the question of wealth inequality depends on the relative rate of change or the relative price level of housing as compared with equities. So it's a very difficult issue. Now, the second part of the question was, does the Monetary Policy Committee take that, the effects on either income or wealth inequality into consideration? And the answer is they are fully aware of it. But the argument that is made in the Monetary Policy Committee is that they have a mandate which was given to them by government, which is to achieve an inflation target. Should the measures that they take to achieve an inflation target result in worse inequality, then it is up to the government, not to the central bank, to rectify that. So monetary policy committees, as a generality, regard the impact and current developments in inequality as not being their business. We're at a very difficult point in time because of the COVID crisis, which has had really dramatic effects. And in the short run, it has actually been reducing inflation because of the decline in commodity prices such as oil, and in the various measures that have been undertaken. For example, the Chancellor of the Exchequer's willingness to reduce stamp duty and to lower the VAT on dinners taken out in restaurants on Mondays through Wednesdays. So inflation at the moment is even lower, and inflation has been below target, particularly in the US, for quite a number of years. And so the short run response has been to say, well, since it's been below target, maybe what we ought to do is to have an average inflation target and allow inflation to rise over target for a period of years. If I was at all confident that it would be easy for central banks to return after a short period of higher inflation back to the previous inflation target, I would say that was a perfectly reasonable thing to do, but I'm not. I think that because of the trends that I've already described in globalization and demography, that once we allow inflation to rise to say 4 or 5% for the next 2 or 3 years, and excuse that on the grounds that this is simply catching up from the lower inflation that we've had previously, that the central banks will then find it extremely difficult to rein back and come back to 2%. And in a more inflationary world, what will an average inflation target do? If let us say that in the US, they run at 5% for 2-3 years and have more than matched the undershoot of inflation relative to target for the previous 10 years, then let's say there's another year of inflation at say 4%. Do they really expect to go down to zero after that? And take the UK, for example. The UK is one of the few countries which, for a variety of reasons, the average inflation since 2000 has actually been, as I recall, slightly above 2% still. Should we aim for below 2%? I think that's very unlikely. I think that, in fact, the for understandable reasons. I can see the pressures. I think the Americans have backed the wrong, or rather the Fed has backed the wrong horse at the wrong time. Yes, I do. And much of what your colleague said was exactly right. But I think he misses out on one point. And that is that the bargaining power of labor is very much what helps to determine the amount of inflation we will have at any particular level of unemployment. Now, the bargaining power of labor is considerably higher in those areas where the workers are all together in factories and can be organized as a group. And one of the features that we've had of the last 30 years has been a really steady, sharp decline in the amount of private sector trades union membership. The shift of production from manufacturing to services, in particular to what is known as the gig economy, has pushed a much larger proportion of workers into areas where they're not unionized, where they have very little bargaining power, where their capacity to demand and achieve higher wages has been very much reduced. To put it another way, if you're a member of the Union of Auto Workers in the US or the equivalent in the UK, you're in a much better bargaining position than you are if you're sort of handing out sandwiches at one of the pret-a-manger sandwich shops. So the shift from manufacturing to services of itself has lowered labor bargaining power, and the reduction of labor bargaining power has been a factor in reducing the wages growth at any given level of unemployment. Or in other words, the shift from manufacturing to services has shifted the natural rate of unemployment downwards. So whereas we used to think of the natural rate of unemployment at which inflation would remain stable as somewhere perhaps between about in the USA between about 4 and 5. It's probably considerably lower than that now, and the same is true in the UK. So you've got to take account of the effects of all these changes on the bargaining power of labour. I think that it is right and proper for a government to try to encourage and enhance growth within their own country. I think it's part of what governments should be doing. Indeed, I would go further than that and say that one of the key features of whether the less developed economies in the world can grow fast will be the extent of competence, ability, uncorruptibility, and drive to that end of their government. And the Chinese growth, which has really been quite stunningly remarkable, has been in some large part due to the fact that the administrative capital in China, the ability to push forward growth, particularly under Deng Xiaoping and subsequently, has been remarkable. And indeed, if we're thinking about the question of what's likely to happen in the areas where the working population is still growing very rapidly, Africa and India, a great extent of whether they succeed, well, they will succeed in part, but how far they will succeed will depend on the ability of their governments to foster growth in their own countries. The answer to that one is yes, as many economists have actually analyzed and documented. The problem about immigration is not the economics of it, it's the politics of it. The Brexit vote in the UK was very largely, though not entirely, of course, an anti-immigration vote. Think about the Italian views about immigration from North Africa. Think about Trump and, building a wall. A very considerable increase in migration from the populous and underdeveloped countries to the populous countries would economically make a lot of sense. Politically, it is just not feasible. The bad news is that we have a system under which it is almost impossible to place any external pressures onto creditor countries, onto surplus countries. There is no really good way of doing it. It's been devised, or as far as I can see, that is likely to be devised. The good news, if you can call it that, is that the countries which are now primarily in surplus, Germany, China, and the oil-producing countries, are likely to be the countries which are going to be most severely affected by the sudden and really adverse trends in demography. And that means that the current account surpluses that those sets of countries currently enjoy are, over the next decade or two, going to disappear. So that the question of which countries are going to be surplus countries in 15 or 20 years, we don't know. But it's not likely to be China, it's not likely to be Germany, and it's not likely to be the oil-producing countries. So we will always have the question of how do you maintain symmetry, but it's going to be a different group of countries which will have surpluses in future years. Many of the current deficit countries may become surplus countries. My crystal ball, unfortunately, isn't sufficiently clear for me to say which I think might achieve that. I think my concern is actually slightly different. My concern is that we've got a system whereby if the economy sags and fiscal policy is under pressure, as it will be because the debt ratios are so high, that the only thing that we can do at the moment to bring about a restoration of high employment and equilibrium is to lower interest rates and encourage the accumulation of debt. And if you have a long period in which the economy has sagged, this means that you build up debt more and more and more. And that is potentially a ticking bomb. And if and when that actually explodes, we'll really be in severe trouble. How do we defuse the debt trap bomb? And that's a major question. I don't know, but it's a sufficiently important question that I think that it brings the whole issue about the structure, nature, and fundamental form of capitalism under severe question. So I'm much more worried about the fact that monetary policy encourages debt accumulation, if it's to be expansionary, than worried about the question of whether it has got too many objectives, that its mandate has expanded too far. I think, as I said at one stage in the answer to a question in my first presentation, partly because of my own prior position as a central banker, I think that they're perfectly capable of handling financial stability issues in addition to price stability issues. So that's not my worry. My worry is the one that I've just been saying, that I wish there was some way that we could, other than fiscal policy, where we could make the economy stronger without doing it by encouraging debt accumulation.
Thank you, Charles. We have a topic for the next webinar series then. No, and I agree, of course, that it should be price stability and, of course, financial stability as well. But thank you so much for your time. for your generous time taken to give the presentations and answer the questions too. So hopefully we'll have you on board in the next forthcoming events of the Institute, indeed in a conference that we'll have later in the autumn. And this series is going to be continued by Professor Forrest Capie in the next 2 weeks. So at the same time, same day, with a discussion on the roles of central banks in times of financial crisis. So again, thank you very much, Charles, for your collaboration with the Institute. It's been a pleasure to host your lectures. And thank you all viewers from home for your attention.